The market is in full celebration mode, reacting like a kid who just got a piece of chocolate. But is this short-lived joy really good for the long term? Let's talk about why the Fed's recent decision is causing a surge in the market and what it could mean for your portfolio. First, Jerome Powell recently made his big announcement. And while rate hikes were expected, what we're seeing instead is a slow, steady pace that many think is too cautious. The Fed will now increase tapering to $30 billion a month, which was anticipated, and they're projecting modest rate hikes for 2022, 2023, and 2024. By 2025 and beyond, they envision a long-term rate target of just 2.5%. In short, the Fed doesn't plan to go as aggressive on interest rates as some had expected. But here's the catch: many analysts believe inflation will hit double digits in early 2023. Some, like Mohamed El-Arian, have argued for a stronger stance, warning that staying behind the inflation curve could backfire. The risk is clear: pushing rates too slowly might prevent a stock market crash now, but it could lead to runaway inflation and even recession down the road. Let's break down the numbers. While rates are set to hit 0.75% next year and hover around 1% in 2023, these projections are more cautious than expected. This leaves the market with a sense of relief, as a full-blown rate hike wasn't imposed. But there's a downside to this comfort. A long-term inflation target of 2.5% is optimistic, considering how much inflation has accelerated. It's as though the Fed's message is, enjoy the market gains now, even if that means risking inflation in the years ahead. And the market is taking the hint. Stocks surged as soon as Powell's statement was made. Why? Because the Fed essentially assured that even if rates rise, they won't rise beyond what's tolerable for stock valuations in the long run. Investors view this as a green light to continue the rally. This is great news if you're a short-term swing trader. Markets are celebrating, and for now, this party may continue. However, there's concern over what lies ahead. If inflation keeps climbing and the Fed doesn't act quickly enough, the economic recovery could face significant risks. So, what does this mean for you? Well, if you're looking at short-term trades, you may see some excellent gains. But for those focused on long-term investing, this cautious approach to rate hikes could signal potential volatility down the line. Let's wrap this up. The Fed's decision, while well received by the market, could bring a significant challenge in the future. The market right now is reacting like a kid who just received a treat. But as inflation continues to grow, the question remains, will this short-term happiness lead to long-term consequences? Let me know your thoughts below. Do you agree with this cautious approach, or do you think it could cause problems down the road? And as always, don't click anything, don't smash anything, just enjoy the video. If you want to join our community and support us, check out our Patreon, link below. Thanks for watching, and see you tomorrow.